And there you have it. The markets are officially closed on this Friday, September 5th. Welcome, investors and traders. I'm AJ Monte, and this is a weekly chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And the reason I'm showing the weekly chart is because you could see that we have what looks to be almost a triple top right here. We need a little bit more of a pivot, possibly next week. We'll see. But as I zoom in here, you'll see what I'm talking about. This candle right there, as I magnify that, is a half signal. A half signal is a higher high and a lower low, or another half signal could be a lower high with a higher low. This is a higher high, lower low, following a doji right there from last week. Now, if you're following along with my weekly Technical Tuesday videos, you'll know that a doji, along with spinning tops, tend to show up at pivot points. You can see back here, this was a doji. Back here on this high, these were spinning tops. Now, if we come in next week with a lower high and a lower low, then that would be a pivot. My downside target is still down here. As I magnify that, you can see that little diagonal red line there. Now that is most likely going to hit. Can't guarantee anything, of course, but if you look back here, we had the same angle with the same divergence from the 20-week moving average. This wide divergence is what we call the rubber band effect. The market does not like to stay that far above that moving average without retracing back to it. So we call that snapback the rubber band effect. And so with that target right there, just above the 20-period moving average, I feel good about that hitting. We'll have to see. But down below, you could see that we have this long stretch of green. That's 5 green candles in a row. And while the candles are green, look down below, you could see that the stochastic is hinging right there, and the CCI is pivoting and very close to a sell signal. Now again, this is the weekly chart, and the weekly charts take precedence over the daily charts. Monthly charts, of course, are heavily weighted for investors, and they will override the weekly and the daily. But that is also a negative divergence. You see that? We're seeing the negative divergences after a higher price high. You can see the lower highs on the oscillators down here, and that's going to be the same in all markets. And so looking at IWM, which is the Russell 2000 ETF, again, a lot of green, 5 green in a row, another half signal, higher high, but a lower low. Down below, you could see that we have a hinge on the CCI, and we're approaching this high back here from November 2024. So we could be seeing a possible M-top, also known as a double top. And if you look down below, we're seeing lower volume reads on the higher prices. So we're starting to see some fatigue on the buy side. And with this one, you can see again, my downside target is right there at that red line, very close to the 20-week moving average. Now again, this is a wide divergence from that moving average, just like what we saw here back in November. And so from November of last year right into April of this year, we saw this major downturn in the markets. And I do believe we're going to see something like that, maybe even a little bit more severe, but that's my overall long-term bias. Many of you know that we still have a lot of long positions that we're playing, especially in the super spread service that we have, which is mainly option spreads. Just a quick shout out to those who have UNH. You can see UNH has done a nice job bouncing off of the lows back here from a few weeks ago. And looking at the daily chart on UNH, you can see that we had a nice green candle on a down day today. So this is a very interesting market because not all stocks are going down. We do have a good number of them that are still trading below the 50-period moving average. This is the ticker symbol if you're interested in that. So you see SPX A50R What that's telling us is that there are 58.65% of the S&P 500 stocks are above the 50-day moving average. But that also means that there's 42% of the S&P that's now below the 50-day moving average. So the market is actually getting weaker. This is a great ticker symbol to track. Again, ticker symbol $SPX, I'll magnify that there, $SPX, the letter A, 50, that's for the 50-day moving average, and R. The A represents above the 50-day moving average. And so there is a shooting star on that indicator right there. Again, this is not a stock, it's an oscillating index. It'll never be at 100 or 1, representing 100, and it'll never be at 0, because there's no way that every single stock in the S&P 500 is going to be below the 50-day moving average. So I use this very similar to the way we look at the VIX. So keep that on your watch list. Okay, so while we're talking about the S&P, let's go right to the SPX. I'm kind of hopping out of sequence. I'll go back to the Qs in a moment. But looking at the SPX, you can see that we have this red candle that's very closely related to what we would see in a hanging man. Now, while the S&P did set a new high today, it closed with that red candle, and look down below, the CCI is actually pivoting lower on that candle. Now, taking a step back, I want you to see what I've done and I continue to do with regard to the fan lines. This is a monthly chart of the SPX showing the initial base trend line, then the accelerated trend line, which is known as a fan line. So that's fan line 2. Fan line 3 is the more accelerated fan line here. And then as I zoom in here, I had the most vertical fan line here, which broke 2 months ago. So if you're following fan line rules, you'll know that once the most extreme fan line in the sequence of fan line breaks, there's now an 80% chance that the prices will drop to the next fan line in the sequence. Remember, I teach through repetition because I've always believed repetition is the best teacher. And so you could see the rounding effect here in these oscillators. It's telling us the market is getting tired. And if we start breaking out below the 20-week moving average, then I think you're going to see an acceleration in that downturn, very similar to what we saw back here and into the end of that down leg in April. And so be prepared. I tell our members all the time, you can't lose money taking profits, and you really can't go wrong being defensive, even if you have a short-term bullish outlook. To be defensive, especially in the month of September, is a really good idea. Now, if we go back to SPY, which is the ETF for the S&P 500, and I go to the daily chart, you can see, again, red candle with the CCI pivoting lower. Remember, I was talking about the negative divergence. Well, there you go again, lower highs on the CCI after higher highs in the price action. So that's a negative divergence. We generally see that right before big sell-offs. And so that's what we are doing. Basically, we're using the charts to more or less forecast the price so we can position properly and not get caught off guard. Now, as I mentioned, we'll go back to the Qs. Looking at QQQ, you could see I have my fan lines in place on the daily chart. And while the Qs were trying very hard to get back up over that fan line, it's failed to do so. And we have this red candle known as a hanging man. And if you're interested in learning more about what we're doing on Technical Tuesday, just go to our YouTube channel and go to the Technical Tuesday playlist. And off to the right here, you'll see all the topics, hammers and shooting stars. And you could learn about the dojis and the spinning tops, which is what I'm talking about here today. If you want to know more about engulfing candles, there you go. You've got that whole selection right there for you. And those are very short videos. You could think of these as your weekly financial vitamin, right, for technical analysis. And every Tuesday we'll put out a new one. We'll talk about the technical signals. We'll talk about price patterns. And if you want me to talk about a particular technical analysis signal or a pattern, just put it in the comments page and I'll do my best to produce a video that is about that topic. So again, we are very interactive here on this channel. And if you're interested, again, just like the channel, subscribe to the channel, and of course you could comment, ask questions, put ticker symbols in there, ask me about the technical signals, and I'll do my best to produce videos to help you out with that. Okay, so the QQQs, we got that negative divergence again down here. And if you take a step back and look at the 3-year weekly, you could see the fan lines, how they're accelerating. So now that we've broken the most extreme or most vertical fan line in that sequence, we're expecting an 80% possibility here of a pullback to the next fan line in that sequence, which means that the Qs could pull back 76 points if you look at where it's trading right now, based on what this fan line looks like right around 500. That is a real possibility. Again, not a guarantee, but it is a possibility, especially when we're seeing such a vertical fan line such as this one here. Now let's take a look at the VIX. We're going to stay on the daily chart for the VIX so you can see what's going on. If you caught our live broadcast on Wednesday, I pointed out this bearish engulfing candle on the VIX and did say that we could see the VIX drop with a possible rally in the general markets towards the end of the week. And so that bearish engulfing candle played out exactly as we expected. But guess what we have here? That is an inverted hammer. We don't talk about those all that much, but an inverted hammer is bullish. And if you are following hammers, right there, there's a hammer candle, and you flip that on its head. Inverted hammers are found at the end of downward legs, and they're identified by a small body with a long shadow on top. Again, taking that hammer and just flipping it on its head at the end of a downward leg tends to lead us to higher prices. Now, remember, the VIX, for the most part, is inversely related to the S&P. So if we're expecting a higher VIX, that would suggest we're going to go lower on the S&P. So that is what we have there on the VIX. Now, I want to do a couple of shout outs. While this is not the trade of the week, it is certainly a great trade that took us a lot more than a week, and that is in GLDG. I pointed this out months ago as our members bought into this one last September of 2024. And I can tell you what I've been personally doing with this one. I've been accumulating this and more or less scaling in and buying it on the lower levels, buying the first lot at a high and then gradually buying on these lows intentionally is very similar to like a dollar cost averaging strategy, not cost averaging down, because cost averaging down is a strategy that's mainly used by traders trying to trade out of a losing position. This was an intentional accumulation of this one using premium collected from option trades that I had done. And I recently sold out of GLDG for a nice profit. And now what we have right there, as I magnify that, that is a hanging man candle. So I'm expecting GLDG, gold, silver to pull back at least a little bit, at which time I will parlay the position and get back in. So with this one, I would be interested in buying more of it down between 90 and 95 cents. This is a gold mining stock. It tends to do very well in small increments. This one does not move big. It'll move sometimes in fractions of a penny because it's more or less a penny stock, but it's a fun one to trade, and you could put it on your watch list. Even if you don't trade, you could watch it. Another one I want to mention is SLV. For those who are following me on X, I put out a post letting our members know and followers know that I sold out of 15% of my position on that doji right there. And I'm looking to buy that back a little bit cheaper and buy more of the position. You know, today silver opened up about 60 cents higher, closed up 28 cents, but that's a bearish candle. I'm not going super bearish on silver because it's in a significant upward trend, which is a bull market for silver and gold both. But I am looking to buy it back down at the gap fill area down here. Down below, we're very close to a sell signal. For those who are silver traders, that sell signal would occur once the blue line, which is the percent K, crosses the red line, which is the moving average of the percent K, and that's known as the percent D. Don't want to confuse you there. Just think of blue and red. When the blue crosses the red, it's a sell signal. Now, for the CCI, the sell signal is generated when that blue line, which is the CCI, crosses the red line, which is the 100 mark. When it crosses below 100, traders take that as a sell signal, and then they take action against that, and they'll start to lighten up on some of their position. Now, today was a big surprise because if you were following the jobs numbers, we had a very big miss in the non-farm employment change. 22,000 jobs. That was it. A big miss from 75,000 jobs. I'm very surprised to see that the markets did not have a harder sell-off when that number came out. But, you know, a lot of folks are watching what the Fed is doing because they are, again, talking about rate cuts, and that's called the Fed put. When they continue to talk about rate cuts in a down month like September, what they're trying to do is they're trying to hold the market up. Whether or not they're going to be able to cut rates, we'll have to see. But inflation is still moving forward. And if they cut rates, that's going to open up the door for inflation. And this could make for a very interesting market. It could even lead us into a stagflation type of a scenario for the general markets, which is a recession plus inflation. That's the worst kind of recession that you could possibly get. If you're interested in following these economic numbers, I have forexfactory.com up here. You could just go to forexfactory.com, bookmark it, and you'll get those numbers coming out as soon as they're released. They're pretty good about that. So that is it for the weekly market report. Thank you so much for following and liking and subscribing. Remember, those comments are read. Every single one of the comments that are submitted are read and addressed. And if there's a question, we'll answer it for sure. And that is actually helping us get that algorithm to put us on the menu. So thank you so much for helping us grow this channel. It is because of you that we are growing, and we appreciate that very much. Have a great weekend, and we'll talk to you next week. So long.
In a world of endless data, where every second counts, introducing Nod Live, your professional compass in the chaos of the stock market. Nod Live cuts through the noise. Stay ahead with Nod Live.